right, good afternoon. One of the objectives of the IMF is to foster financial stability. Now, we monitor markets on a day-to-day basis, but we also look at longer-term trends in terms of dynamics and market structure. AI has the potential to transform financial markets, their structure, and their dynamics. And for that reason, we have done a deep dive on the impact of AI on capital market activities in our latest Global Financial Stability Report, which can be found on the IMF website now. In our work, we have focused on capital market activities, meaning that we haven't looked as closely at the banking sector, but really focusing on markets. And we have considered generative as well as non-generative AI. And our focus is also always on financial stability. So it may seem as if we are biased towards the risks, but that is our job. Key questions that we have attempted to answer in our work are whether the changes brought by AI will be evolutionary or revolutionary, and whether AI will introduce new risks that we can't currently see in markets but could emerge in the future. The approach that we have taken is to first look at adoption. Where is AI currently being used in capital market activities? Before moving into the question of how AI can transform capital market activities, the structure and the dynamics of markets. These observations then feed into a synthesis in terms of the financial stability implications and policy recommendations. I'm going to follow this structure in this presentation. So on this slide, on the left-hand side, we can see the recent growth of so-called robo-advisory. Now, robo-advisory is not necessarily equivalent to AI, but this trend does reflect a broader trend of automation in the investment industry in terms of investment decisions. But if we look at more true, pure AI-driven trading strategies that we can see in the public domain, we see that this is actually quite nascent. One example of a more pure AI-driven investment strategy can be found in the so-called AI-driven exchange-traded funds. So there we've seen growth in recent years as well, as can be seen on the right-hand side, but this segment remains very, very small. So this is less than $1 billion in terms of assets under management. So that's really tiny compared to, for example, the US equity market cap, which you can see on the right axis of the chart on the right-hand side. If we then look at where AI is used in the investment process, we see that investment managers indicate in surveys that they use AI more in auxiliary roles. So for example, to incorporate alternative data sets, to do sentiment analysis. But if we zoom in on the bottom two rows of the chart here, we see that the use in core investment tasks, such as executing investment decisions and allocating assets, is actually quite nascent as well. So we see that only 10, respectively 11% of investment managers indicate that they currently use AI in these roles. If we then turn to the world of trading, specifically algorithmic trading, we see a somewhat similar picture. So we see that machine learning, so more advanced algorithms, are used in so-called signal generators. These are tools that provide a signal to traders, but the trader can still decide to act or not to act upon that trading signal. So there's still a human in the loop. And this is also what a lot of market participants indicated in the outreach that we have done, is that a human in the loop remains preferred. And in these more autonomous applications, like trading algorithms and execution algorithms, we see that the use of machine learning is much more limited. So again, this points to the adoption of AI being relatively nascent in their core tasks, even if most financial institutions use it in some form or another, in the core tasks, it remains nascent. Nascent, but growing perhaps, because evidence from patent filings suggests that the adoption of AI and, for example, algorithmic trading may now be accelerating. So here on the chart, we can see the number of patent filings in the domain of algorithmic trading, and we see this resurgence in terms of the number of patent filings as of 2019. And this is really driven by these gray subcomponents of these bars, and those are the patent filings that contain elements of AI or machine learning. If we then take a forward-looking perspective, we see that investment managers see value creation opportunities here on the vertical axis, especially for asset classes that are more liquid, the liquidity score being on the horizontal axis. So for example, publicly traded stocks. Now, we think that the reason is that in those market segments, there is a lot of data and a lot of high-frequency data in the market, but also from outside the market, that can be used to gain insights. And these markets are also relatively deep and liquid, meaning that small insights can actually be used to gain a small advantage at low cost. So that provides us a picture of what the level of adoption is and what the direction of travel is. So let's move to the second stage of our analysis now, the impact on dynamics and the structure of markets. So one insight is that AI provides one the ability to quickly process new information into a trading signal or investment insight, portfolio adjustments. In other words, markets can trade faster and with higher volumes. And we see evidence for this. If we zoom in on this small segment of exchange-traded AI-driven ETFs, we see that the turnover ratios, the ratio of trading divided by the assets under management, is significantly higher for AI-driven ETFs as compared to other ETFs, active or passive. In other words, AI-driven investment strategies can increase the pace and the volume in markets. Another impact can be seen at the structure of markets. So AI can drive concentration at two different levels. The first one being the level of the infrastructure providers. IT infrastructure is already very concentrated. So on this slide, on the left-hand side, we can see that the top 3 IT infrastructure providers make up for over 70% of the market share by revenue. For AI software providers, this is somewhat lower, but it is also increasing. And this raises questions about operational risk. So what one could have in mind here is an incident like we've seen with CrowdStrike a few months ago. So that could also have systemic implications if a lot of financial institutions are making use of the same infrastructure providers. But AI can also drive concentration at the level of trading activity. And here we can draw some lessons from the world of algorithmic trading and the advent of algorithmic trading over the past 2 decades. So with the introduction of algorithmic trading, a lot of activity has moved towards non-bank financial intermediaries, such as principal trading firms and hedge funds. And with that move, we've also seen a concentration of trading activity. So here you can see for European Stock Exchange that the top 10 traders make up for 90% of the volume. Now, with this move towards non-bank financial intermediaries, markets have become more difficult to monitor, so more opaque. But in addition, these algorithms tend to withdraw from market activity if stress increases. So they provide benefits in terms of providing liquidity, but when stress increases, they tend to withdraw from the market since they have automated risk limits. So there is a question in terms of liquidity that they deliver, but that can also quickly evaporate when conditions deteriorate. Lastly, AI can also be used by bad actors in cyber attacks, which have been on the rise in recent years, and specifically in the area of the finance and insurance sectors. But bad actors can also use AI to manipulate markets. So there's an incident in May 2023 where somebody tweeted a fake picture of the Pentagon exploding. And we saw a market reaction in terms of US equity markets. And this is just the start, perhaps. So we might see more of these examples in the future. So that's another risk area that could impact market activity, especially if algorithms also pick up on social media activity. So lastly, I haven't talked so much about the benefits, but there are definitely benefits driven by AI, also from the perspective of financial stability. Those include superior risk management, improved liquidity, but also tools to monitor markets for market participants, but also for regulators. So I've discussed the risks already, and in the report, the Global Financial Stability Report, you can also read our policy recommendations that follow from these benefits and risks. But I will leave that to you. I would invite you to take a look at the report. Thank you very much, and I think I will clear the floor for the next speaker. Thank you.